All right, let's dive into the latest earnings report from the financial services giant Raymond James. Their first quarter of 2026 it was a really fascinating story of highs and lows, and we're going to get right into what it all means.
So here's how we're going to break it all down. First, we'll unpack those conflicting headline numbers. Then, we'll take a look at their powerhouse wealth management division. After that, it's on to the pressures facing capital markets, what the company's doing to invest in the future, and finally, we'll wrap it all up with the key takeaways.
Okay, so first up, let's try to understand the mixed signals that really defined this quarter. Because when you first look at the numbers, they almost seem to be pulling in opposite directions.
And this slide right here, it perfectly illustrates that central tension. On the one hand, you've got the company's profitability that's measured by earnings per share, or EPS, and that was actually stronger than Wall Street was expecting. But then, on the other hand, their total income, their revenue, that fell a little short of the mark. Let's put some real numbers to this. The earnings beat was pretty slim, just about 3 cents per share. But the revenue mess, that was over $91 million. That's a pretty significant gap, and it definitely needs some explaining.
So yeah, that begs the question, right? How can a company be more profitable than expected while actually bringing in less money than everyone thought? To figure that out, we really have to pop the hood and look at the different parts of the business. And a big part of the answer lies right here in the company's absolute powerhouse division, the Private Client Group. This is the part of the business that manages money for individuals. And this quarter, it was just on fire. I mean, just look at that number, $31 billion. That's the amount of new money from clients, they call it net new assets, that the wealth management team brought in this quarter alone. If they could keep up that pace for a whole year, we'd be talking about an 8% growth rate. That is just incredible momentum. The CEO, Paul Shukri, he credits their strategy of focusing on these deep personal relationships, something he calls the power of personal. It's a classic approach, but in a world that's getting more and more automated, it turns out that human touch is a huge, huge advantage.
And this success isn't just coming from their existing clients. No way. Raymond James is basically a magnet for top talent right now. In just the last year, they've brought on financial advisors who are managing a whopping $69 billion in assets at their old firms. We're not talking about rookies here. These are seriously high-performing, seasoned pros.
Okay, so now let's flip to the other side of the coin. If wealth management was the engine pushing everything forward, well, the capital markets division was kind of the anchor this quarter. And this is where we find the reason for that big revenue miss we talked about earlier. This chart, it tells the whole story, really. Just last quarter, the capital markets segment brought in over $500 million. This quarter, that number dropped all the way to $380 million. That's a steep decline, and it's what dragged the company's overall revenue number down. So what happened? Why the big drop? Well, this wasn't necessarily a misstep by the company itself. It was more of a reflection of what was happening in the broader market. There was just a big slowdown in major corporate deals, what we call mergers and acquisitions, especially when you compare it to a really strong period last year. So it was just a tough comparison. But hey, Raymond James isn't just sitting around reacting to market swings. Let's shift gears and look at how they're actually investing and making some really strategic moves that are all about long-term sustainable growth, no matter what the market is doing in the short term. A perfect example is their recent acquisitions. They announced deals to buy 2 companies, Clark Capital Management and GreensLedge. These moves are all about beefing up their asset management and investment banking arms for the future. They're definitely playing the long game here. And it's not just about buying other companies. They're also building some seriously cutting-edge tech in-house. Meet Rye. It's their new AI operations agent, and this whole tool is designed to make their financial advisors way more efficient, automating all the routine stuff so they can spend more time actually focusing on their clients. It all fits into their very clear 3-step plan for using their money. Step 1, invest in their own growth. Step 2, make smart acquisitions. And step 3, return capital to their shareholders, which, by the way, they did this quarter by buying back $400 million of their own stock. Okay, let's pull all these different threads together now and really summarize the most important things you need to take away from this quarter of contrasts. So here's the bottom line. First, their core wealth management business is absolutely thriving, and it's all powered by that power of personal strategy. Second, their capital markets division is navigating some tough industry-wide headwinds, and that explains the revenue miss.
Third, the company is clearly playing the long game by investing in acquisitions and new tech like AI. And finally, and this is important, despite those challenges, their underlying profitability is still super strong. They even hit their key 20% margin target.
And that really leaves us with the big question for the future, doesn't it? Raymond James is making a big bet that a long-term strategy, one that's focused on both personal relationships and technological innovation, can win out against all the unpredictable swings of the market. I guess only time will tell if that bet is going to pay off.